All right. I guess it's official. We're live, Uncle Sean.
It appears to be the case, yes.
There we go,
So
baby.
we got to watch what we say now.
All right. Well, we're gonna get on here and kind of have a little fun with each other before we get into the weeds of these numbers. So, Sean, you got any good uncle? Got any dad jokes?
Yeah, I've got one. I got one actually teed up for this week. So I found myself face down in the gutter one time. I just didn't quite expect everyone else to keep bowling.
Oh.
Oh,
Oh
oh,
man.
Come
nice.
on, that was great.
The amount of people I walk into at these conferences and they're like, "I follow Uncle Sean purely for the dad jokes."
That's apparently that's the only value add that I bring to the table. So
I'm just glad we finally found it. Let's be honest.
finally found something that I can just hang on to. Yep.
Oh gosh. We'll still got a couple more minutes here, and we'll get going.
Yep.
Oh, here we go. We got one in the chat. Look at this, Sean. Why don't software
Uh, Too
like
many bugs. Too many bugs. Why don't software developers like the forest? Too many bugs. I like it. That's a
Don, you
good
got any
one.
good dad jokes, buddy?
Nope, none from New Jersey. We're
Okay.
serious up here.
See, all serious. Yep.
If
I
I'd
guess
known it was joke time, I would have come prepared.
so. Don, do they allow cowboy hats in New Jersey? I'm asking for a friend.
Oh,
That's awesome.
All right. We'll give it another minute or two.
Yeah, we still got folks pouring in.
Rick
well,
Bowl,
we're looking forward to entertaining you all here up here in New Jersey.
that could be.
I don't know how we're going to meet the giant barbecue that when you had us down there. We're probably going to have to go like a crazy Italian night or something up here.
I'll tell you, hosting Tanner and I, that could be scary. So I know you're saying excited, but you might need to be more pensive than excited.
Uh,
All right. Rick, how's Tennessee, my friend?
Beautiful day today. Beautiful day. We had storms earlier in the week, but we're good today. All is well.
I'm good. We had something falling out of the sky that I never saw in Amarillo a couple weeks ago. The locals told me it's called rain. In Amarillo, we didn't know what that stuff was. So.
Uh,
well, we could bottle it up and send it down to you. We got plenty.
Oh, please do.
All right.
You tell me when you want me to kick this thing off, and I'll give it a try.
I think we're there. So let's go ahead and get it.
All right. Well, first off, I just want to say thank you to everybody for joining. My first time to moderate this thing, so I might be a little nervous. I'm here with four incredible experts, but I'll do my best to carry this thing. Real quick though, before we kind of get going, I just want to say, we've had a lot of people reach out. We lost our founder, Dave Mayo, about 4 weeks ago, and this was pretty much one of his favorite things. He loved Inside the Numbers. And for all of you though, that reached out to us, shared some love, we greatly appreciate it. But I'm going to say this. Like I know Dave, Sean, just like you do, and he would tell us, hey, you better pull up your bootstraps, boys, and let y'all go kick some ass on this webinar. So you ready to kick some ass, buddy?
Yes, let's get it going.
All right. One more thing before we get going. Got a shout out to these guys on the screen right here. These are the sponsors for BHB. They make sure that we do a lot of pro bono work for banks. In fact, almost all the work we do through Bankers Helping Bankers is pro bono. So thanks to these guys. These guys are the good guys. Speaking of good guys, we've got one joining us today, a special guest, Don Musso. Love that you're one of the good guys supporting our cause out there. Welcome to Inside the Numbers, my friend.
Thanks for having us. We look forward to it.
Yeah, absolutely. Well, Sean, I'm going to do my best to shut up and not derail this thing too much with a bunch of stupid questions. So I'm going to turn it over to you, buddy.
Kick us off.
Let's go.
John,
There we
I'm
go.
going to let you start with a an economic update, if you will, and take us through the slides that you've prepared. And Don, I know that you will have comments, you and Alan, that you want to add as we go through this. So with that in mind, Sean, take it away.
Yeah, so we had an FOMC meeting this week. Uneventful from a rate standpoint, but there's a lot of moving parts going on. And in the world today, we've got a war, we've got gas prices going through the roof, we've got a new Fed chair coming in, we've got the Fed balance sheet reduction as well as restructuring, which I don't know if anybody on the call, or I'm actually let me rephrase that. I'm sure many people on the call actually follow FinPro's economic updates every quarter. These guys do a fantastic job. So I'm actually stealing some information from them. So I'm going to give them kudos throughout some of this. But um, Jerome Powell in his final press conference was a little more open than usual on several topics, but he basically states that economic activity is still expanding at a solid pace. Job gains remain low, but employment is little changed, and some of that has to do with labor participation, AI efficiencies, and inflation has obviously moved up. We did get some new PCE data about 7:30 this morning, which we'll go over here in just a second. And then the balance sheet restructuring, we're going to hit on this a little bit more further on, but I think that's really important. I think Don would probably agree that what we're seeing is a runoff on MBS. So I don't see anything that's going to help the long end of the curve, or at least the intermediate to long from 10 plus. And a lot of that is pulling back into the directive as treasury bills at 3 years or less. So there's going to be perceived demand on the short end of the curve, which has a potential to push those rates down. And again, we'll get into a little bit more of that here in a minute. But I think if we look at the overall inflationary picture, you see what we went through post COVID. The purple line is the FOMC rate, Fed funds rate, and then the other lines are just various components of inflation, whether it's CPI, PCE, and core, and on both. And you can see if you kind of squint your eyes, we've got a nice glide slope there for a while, but here towards the end, we've definitely seen some spikes. So go ahead and take us one forward here, Rick.
Before we do, Don, I wondered if you might want to comment on rates and your thoughts about the holding steady yesterday from the FOMC and where we might go from here.
Yeah, I think I agree with your assessment. I think long rates are going to stay high, maybe even rise a little bit. We attribute that to the supply demand mismatch. We've got to fund a $39 trillion deficit, and we don't have enough buyers right now. And the more we alienate the foreign countries, the less buyers we're going to have. So I think that gap's going to get bigger, not smaller. On the short end, it really is a question of I guess market perception more than anything else. And I think the market's looking and saying, well, we think inflation is going to go up. Therefore, without any real justification, we're going to move the short end of the curve up a little bit. I think we're going to continue to have a normal sloped curve, but I think it's going to flatten. I don't think it's going to be as steep as we saw it, and most recently. What I found really interesting in conversations that we've had with folks in Washington recently, when you look at the long end of the curve in particular, they're doing everything they can to create demand for treasuries. That's why stablecoin came about. And, everybody thinks that stablecoins being promoted by the government for an altruistic reason. No, not at all. It's because it's collateralized with treasuries. And so they're trying to create demand. And so, boom, stablecoin comes along. No matter what they do, they're just not going to be able to bridge that gap. And already interest on the debt is number two. So part of what Sean you just pointed out that I think is dead on. They're going short because they can't afford to pay up here at the high end, and that's going to create a problem for us if rates do all of a sudden climb. So we have a bad interest on the debt problem now. It could get worse if we see any kind of rate backup scenario.
Thanks,
100% agree. Yeah, I completely agree. Actually, on top of that, early this morning, we got some GDP data coming out. And now this is our first estimate. And I know how much Don loves government data and the accuracy of such. Now, as always, GDP will be adjusted 2 more times before the final data is out. But a quick look at what we're seeing early this morning. Again, this is the first estimate of first quarter GDP. Consumer spending came in at a little north of 1%. I highlighted that yellow because fourth quarter was at 1.3, and overall GDP at 2% was a big jump from 0.50. Now, the BEA did mention last quarter that they felt that the government shutdown contributed somewhere around 1% of or a negative impact of 1% to GDP. So we could have been normalized around 1.5. It's hard to say. So this is a little bit of a bump up from there. Business investment is up, government spending up, exports are up, imports are down. Exports and imports, I kind of struggle with a little bit because I think there's still a lot of tariff tantrum uncertainty, I guess, in play. And so you'll see some movements back and forth there. But when you go through and you look at a lot of the detail on business investment and exports as well, a lot of this is kind of computers and peripheral equipment, which really points towards AI infrastructure here in the United States as well. And I guess the last thing I would close out with on this is the real final sale to private domestic purchasers. I look at that as kind of like core GDP, if you will. That came in at 2.5, which is an uptick from fourth quarter at 1.8. And again, these are early prelim numbers. There will be 2 more estimates, and I would agree with Don. I would expect material revisions to take place as we move forward.
The good news here is that Scott Bessent came out and basically told the exact story that you just did, that this economy is chugging along really nicely, and that there's some spending issues that are going on right now, but that has not slowed this economy one iota. The U.S. economy continues to chug along.
Slide here is just kind of a historical look of where we've been on real GDP numbers and kind of the change from quarter over quarter. Nothing really much to see here. Nominal. This one I like this slide here. So I put on here that consumer spending really pushes a lot of the economy, and so I have on here in question marks on purpose a healthy consumer. Because if you look real close to the end of this graph, you have for a long time you've had nominal wage increases outpacing inflation, and unemployment being steady. Now we're starting to see unemployment, kind of hanging in there, maybe ticking up a little bit. There's other factors at play there as far as labor participation and other things and efficiencies. But as nominal wage increases continue to slide down and inflation creeps up, people are going to be less and less happy about how much money they're making. And my fear is that creates contraction in consumer spending going forward. Go ahead and kick us forward one, Rick. So this morning we did get some additional information out on, like I said, on PCE. Basically, we've got PCE headline inflation was 3.5%. Obviously well above the Fed's target of 2%. And even if when you take out energy, core is at 3.2. Now, particularly when I look at disposable personal income and outlays, and then the savings line, that black line on the top, we see a big bump in income in January. That's kind of normal. If you think about it, you've got Social Security resets starting in January. You've got raises, a lot of corporate raises actually come into play in January. But that orange line or that orange bar of expenditures outpacing income is a problem. And so the punchline here is that's pushing the personal savings rate down, and that's just additional stresses on the consumer. So take us forward.
Yeah, yep. Before we leave that, Don, do you or Alan want to offer any insight there or any comments?
Alan, go ahead.
Don, no, I'll defer to you, Don. Go ahead.
Yeah, I mean, I'll tell you what I find really interesting here is 2 things. First is all we hear about from the Democratic side of the House is the level of spending and how consumers are getting poorer. And yet the chart that you just showed on the prior page and this chart kind of indicate that that's not necessarily the case yet. I think what's happening here is that there's going to be certain job sectors that are just going to get pummeled. And I don't think it's going to be as broad-based maybe as everybody's expecting, but I do think we're going to see certain components, job components that are just going to get destroyed. And I mean, we're already seeing that with AI. You look at the number of tech jobs, and in particular, now you look at the number of finance jobs being cut back. I mean, last week and this week, every big accounting firm announced a cutback on people because they just don't need that analytical help anymore. So I don't know how you see it, but I think this is going to be sector driven, not necessarily broad across the U.S.
Yeah, definitely. Very well said. So along those lines, when we look at consumer spending, and this is definitely a precursor to the K-shaped economy, but I look at a K-shaped economy a little bit different. This isn't just a conversation of haves versus have-nots. It is sector driven, and more importantly, from the data that I'm getting ready to show, it's really demographic driven. So a lot of the folks in the white hair no hair club are really doing a good job of spending and stimulating the economy. And one thing I want to point out here in both of these changes in consumer spending habits for February and March, and this is a trend that you can go back a long ways. Healthcare is almost always up there in number one or number two in double digit increases, and that points to the spending, the money that's flowing into that sector, right? So there's a lot of funds going there. So and Rick, if you'll kick us forward, I'll even go a little bit further. When you start seeing, and this is a little bit older slide, it's from third quarter, because there wasn't any updated information. But when you look at the spending by age group, you see that 54 and younger is actually trending down, where 55 and older is trending up. And I think that really reinforces this demographic K-shaped economy. And go ahead and take us forward one more, Rick. And once again, when we look at this March information, which you can go in here into the BLS jobs report, and they've got a March to March year over year increase. And obviously, the leading one up there is healthcare and social assistance employment. That's where the jobs are being created. So it makes sense. That's where the money's being spent. And so the investments as far as jobs are rolling into that same sector. And realistically, I'm sorry, go ahead, Rick.
Would you just take a minute for those in the audience who may be wondering what you mean by a K-shaped economy? Could you just elaborate on that a little bit, please?
It's a question of have versus have not, right? You've got middle class and up versus down. Whereas the haves in the economy are really spending more money and generating a lot of that GDP and generating investments into these job spaces. My emphasis on this is really more of a demographic approach, not just the haves and have-nots, but really a focus towards an age split. And it's a wealth effect that's combined with stock market returns, built up equity in their houses. It takes a long time to grow that level of wealth, and then you get the benefit of having to spend it. So.
Sean, if I could just add one quick thing, those are phenomenally great slides, and it points to why banks and financial institutions broadly need to go to customer segmentation, right? Our reliance heretofore has been heavily on the boomer, that over 55, actually a little bit older than that now. And you see that they're actually spending right now. We're not saving as much, we're actually spending. But you go to the younger folks, and they just don't have the wherewithal to save. So it tells me that deposits are going to we already know that they're hard and that we're scrambling to get them. I think it's going to get harder and harder and harder in the near term for banks to attract deposits, particularly if we can't figure out how to get the segment mixes right.
Correct. And you'll oftentimes hear varying viewpoints as well as to, well, we need a rate cut because, we're just not growing. But then you look at the macroeconomic data and it's like, oh, it does show that we're adding jobs. But to your point, if we look at sector specific and demographic specific, there are very few areas that are performing really well, not so much on a lot of them. So there's two sides of the coin there. And I'll finish on the demographic K-shaped economy here by this slide. And we talked about this last quarter as well, where life expectancy, fortunate for me, is continuing to increase, while birth rates are decreasing. So that really paints the picture of pretty much everything that you need to know from that demographic K-shaped economy where we are experiencing an aging populace.
And why we're going to have to figure out legal immigration.
Yeah. Yep. Go ahead and kick us forward one, Rick. All right. So this is another one of my favorite parts, the war in Iran and the WTF on WTI. So for those of you who don't know what WTI is, and this is a slide that Alan sent over, so thank you, Alan, on this. WTI is West Texas Intermediate Crude. That's really kind of how we benchmark oil prices in the U.S. It's different from Brent, which is really what Brent crude is what international and global entities really look towards. And you can see on this left-hand side that Brent and WTI commodity pricing have diverged. They split. There's a premium in there now. That's important, which that tells us that international entities are going to be hit a little bit harder than what we're being hit. And then if you look at this right-hand side here on this gas and diesel prices, this is a historic rise in fuel and commodity and fuel prices. And the problem that we run into here is even though that's energy, that's the headline only, not core. The longer that we remain at these levels, the higher likelihood that this will infiltrate back down into core goods and services and put additional pressures on consumers and businesses alike. So go ahead and kick us forward one, and I've got some pretty good case studies here.
Okay, before we do, I think this is one thing that everybody can relate to. Well, if you have an electric car, maybe not so much, but otherwise. So given that we hear frequently that the United States is energy independent, Alan, would you or Don comment on why it is then that we're seeing the bump up in gas prices? Doesn't that suggest that maybe we are still importing certain types of energy-related products, particularly diesel fuel and jet fuel, and we are exporting a lot of the oil that we're refining here in the United States? Any thoughts on that from the two of you?
Yeah, I'll take a stab at that real quickly. It's a good question. I mean, being energy independent and being independent of the oil supply and demand are two different things. And I think if you go and you look at Western Europe, for example, they're not energy independent. And so, I mean, again, the fact that maybe supply and demand in the U.S. are more equal, we're not isolated to price changes as a result of what's going on. And one of the things, and then I'll turn it over to Don to see if you have any questions, is I look at that previous slide, in terms of increasing gas and what have you. I think the longer that number stays higher, the greater the probability that you're going to see past dues and credit stress in consumer portfolios. If you go and you look at HELOCs or automobile loans or what have you, I mean, if that thing stays at that level for 3 to 6 months, I'd be willing to wage a little bit that you're going to start seeing increases in, like I said, past dues, non-performs, and what have you. And that's the relevance, I think, to this, to bankers and people that are calling on bankers, is the longer this stuff plays out, the more likely it's going to impact banks' performance. It hadn't to this point. We'll see a little bit later, but that's the observation I would have there.
Al,
Thank you.
I'll add to that real quick too. We were at a couple bank conferences a few weeks back, and we had several bankers walk up, and they're talking about this impacting their commercial customers. Some of them, bank truck drivers, and they got the trucking companies.
Yeah.
I think this is going to be a big concern. It's a big concern 2 weeks ago, and I think it's going to continue being a concern. So you got.
Yeah, yeah, that's perfect. It actually leads into this slide. And so when I first started preparing this slide, it was really a concentration on asymmetric pass-through, which is a mouthful. Basically, when WTI goes up, gas prices tend to go up rapidly with it. When WTI comes down, it's a little bit more of a slower decrease, right? Um, and you kind of see a little bit of that in pre-COVID, but post-COVID, that asymmetric pass-through is much more pronounced. We're coming down at a much slower rate, and we've got a bigger gap between the blue and the red lines, right? And we hit a high, and this is non-inflationary adjusted. This is just a nominal intraday high of $147 a barrel in July of 2008. And I've got a little story that I want to share about that as to why that is important to me. Back in 2008, I was a treasury manager, and we were our company that I worked for at that time. We were an importer of, of instruments, and we would resell that. We were a U.S. distributor. Not a big deal. It was actually a very fun exercise. We would submit our purchase orders to the factory 90 days in advance. They would get everything together, load it on the cargo ship from Taiwan. And at that point, I was FOB shipping point. Inventory, the title changed to my name. I'm responsible for marine cargo insurance, so on and so forth. And then it would be on my books as in transit inventory. It would take about 4 weeks to get to the port in California. And then a matter of maybe 2 days after that to reach into my warehouse. Why all that is important is at this time in 2008, when fuel prices skyrocketed, one of the things happened there was the transit ships started what's known as slow steaming or slow rolling to conserve fuel. So what was normally a 28 to 30 day in transit process turned into 45, 55, right? I'm paying my invoice to my supplier, and I still got 3 more weeks before the product ever even gets into my warehouse. Really messes with my DIO, my cash conversion cycle, everything. So I had to really tap out my working capital lines, and I think this is important because and I wrote this down because bank execs and portfolio managers right now, they're already checking on industry and fuel sensitive customers, be that transportation, freight distribution, airline, imported parts, goods, etc. So what does this drill down into on the banking side? That's C&I, working capital, ABL facilities, ag production. We've seen this in the news, diesel, fertilizer, parts. Probably already familiar with these customers from the tariff shocks of last year. Hopefully, we're already working with those customers from a portfolio management and a bank executives. So these are some of the things that you don't have to necessarily be impacted just by the gas prices, but the import prices. And again, the scenario in 2008 played out where it was over in a couple of months. If this remains sticky, these higher WTI prices, these higher fuel prices, this will definitely infiltrate into core goods and services in the way of much higher prices. Anybody want to opine on that?
I have two thoughts that I guess play in here. The first is, we look back at what happened in Venezuela, and what people have to understand is that's a big diesel production flow coming into the U.S. So that solves one of the two issues that we're talking about. If we get nasty and decide that we're going to start keeping it, the interesting part here is we have the perfect opportunity in the U.S. now to increase our refinery capability and to be really totally become self-sufficient and create jobs and do a whole bunch of things. I think my feeling is a lot of the thing that's going on in the Strait of Hormuz right now is they purposely want to hold up the oil shipments because they want to create enough of a cost increase to warrant us doing what we need to do to build in the U.S. So it's going to be interesting to see how that plays out. But I agree with everything you said about from a banking perspective, this does not portend well.
So lastly, last week, the FDIC published a fantastic report. I've spent way too much time going over it because I'm just kind of a weird risk super freak. I really enjoy these things. But this was kind of a look back at how we ended up with 2025. And one of the things I really want to point towards was private credit. Now, I did put some cockroaches on there for Mr. Diamond. And really, it's really more focused on NDFI. And it's been a rapidly growing sector. So much more. If you look at the graph, it's way faster than any other major loan category. In fact, let's see, their compounded annual growth rate of 22.7% from 2010 through to 2025, more than triple the next highest sector, which is multifamily lending, which only grew at a 7.4% compounded annual growth rate.
John,
Now,
NDFIs being
loans to non-depository financial institutions, and that can be broken out into a couple of different categories that we just started tracking recently. But yeah, it's private credit, it's mortgage intermediaries. There's a handful of components in there. But I think that the important piece is this gains a lot of media attention. And I'm not saying it's wrong, but when you go and you look at it, it is very heavily concentrated in the absolute largest of banks. So 80% at year end, 86% of those NDFI loan balances was held by banks with more than 100 billion in assets, and just 10 of those banks held 66% of all NDFI loans. So this, while it's a big number and it's heavily concentrated, it's not necessarily a systemic problem, and really there's hardly no exposure to any community banks. So, and then I think the other thing, the punchline that I put down here, the composition and structure of the bank loans generally exhibit a lower degree of credit risk, and that's straight from the FDIC, right? And I think the bigger issue here from a call report standpoint, if you go back to your bond underwriting or credit days, it's not just the probability of default, it's the loss given an actual default. So oftentimes these loans are very heavily collateralized. We don't know what the LTV is. We don't know what the cross collateralization, chattel paper, et cetera, et cetera, et cetera. So there, in the event of a loss, there may not necessarily be or a true loss to the bank. We just don't know how they're collateralized. But the FDIC did state that historically, from their supervision efforts, these NDFI loans perform better, or have to this point. I guess that's the important thing. And to back to Mr. Diamond's comments about cockroaches, I kind of feel like maybe his comments were more directed towards his team as opposed to the overall industry, because I think they had some cross collateralization effort or cross collateralization problems there, and so I'm pretty sure that was kind of a pointed comment for their underwriters to get your stuff together, guys.
John, I would just add to what you're saying here that even though, as you pointed out, this lending is concentrated in larger banks, just in one-off situations over the last year or more, I'm seeing more and more evidence of that in community banks as well. And I do think that their participation not only is growing, but likely will continue to grow in that sector.
Particularly with mortgage credit intermediaries, correct? Yeah. But not to the material nature that what you're seeing in the large institutions. And that seems to be what's grabbing the headlines, and media always kills me sometimes, because the shock journalism aspect is really there to drive advertising revenues, so that you'll key in. We've seen it with liquidity crisis and CRE melting down and the sky's falling, and now it's NDFI and private credit, and next week it'll be something else.
Yeah, I think the FTC has screwed the pooch on this one. This is not going to be big to the financial institutions, the community banks. And what's amazing to me is that in the next breath, we have the federal regulators approving all the NDFIs to come in and get bank charters. So if they had such an inherent fear of NDFI and the loans that they're doing, why are we giving them all charters, right?
That is an excellent point, a very excellent point.
I just don't think, unless there's wild contagion, I just don't think this is going to be, it's going to be like commercial real estate. It's happening, but then it never happens.
Yeah. So one more thing on this FDIC risk report. Just a quick look at the yield curve snapshot. We talked about this earlier. On that left-hand side, if you look at the different year ends, you can see how the short end of the curve has come down. On the long end, to Don's point, and you guys have been forecasting this for a couple of years.
Yep.
So credit to you guys. It has stayed pretty consistent on the long end of the curve, and I think that has a lot to do with unrealized losses in securities portfolios. We're still, and it kind of baffles me a little bit that we're still seeing a lot of that out there, although it is declining. And the reason why it's declining is some of this is just being sold. They're taking the losses. They're restructuring. Some of it is just a natural runoff as they hit maturity, and the par value goes back to equal. And then those long term rates remaining steady, it kind of helps out. But it does kind of amaze me. We're 5 to 6 years out from the liquidity push that we saw from COVID, and we're still seeing some of this on a duration problem and a yield problem. Any comments on that from your side, Don, on what you're seeing,
No, we agree
and
with you. I
Alan
mean,
as well?
this is an amazing one in that this self-corrects. If you just
Yeah,
hold the security to maturity, there is no hit, there is no loss. There's an opportunity cost, but no true economic loss. Um,
right.
when we look at this, we thought as rates came down on the short end, we thought we'd see a little bit more rapid improvement in the AOCI, but I think you nailed it because the long end just didn't move. It stayed high.
Yeah.
AOCI is staying because it was all in long assets. AOCI has just stayed stubbornly there, and we think it's a 3 to 5 year problem still.
I would agree with that assessment for sure. Alan, you got any comments on this? I know you're pretty well versed in this area.
No, I mean, I think you all hit the nail on the head. I will say with respect to, when this thing first surfaced,
Alan, we're kind of having a
caused a
hard
lot
time
of
hearing you,
M&A
buddy.
to slow down. But I don't think that's the case. I think people that are acquiring institutions feel a little bit better about this, dealing with this as they bring those banks going forward. But with respect to the economics, totally agree with what you're saying.
That's a great point on the M&A side because you're forced into a mark-to-market type of structure on the M&A
Yeah.
accounting. So yeah,
Yeah.
great point.
The big
Um,
battle is going to continue to be with Washington, who continues to want to include AOCI in the capital calculation, and they're
yeah,
trying to eliminate everybody taking the waiver on that. And it doesn't matter how many times we tell them that we if we're going to mark to market, you got to look at the whole balance sheet. They tend to want to cherry pick the worst part all the time, and that's
yeah,
what we're looking at in the AOCI.
yeah. I completely agree there. The last part of this FDIC risk report that I really enjoyed was deposit growth. They talked about deposit growth in 2025, and it was actually led by the growth in uninsured deposits. Um, that made me pause for a moment. I have not seen that information, and I feel bad because I didn't know that. I feel like I should have known that. That's amazing to me. Now, when go back and I did some analysis on that, and as expected, the growth in uninsured deposits is indeed heavily concentrated at the largest banks, the too big to fail bad boys. Um, However, they go on to note that there's been substantial growth, double-digit growth in reciprocal deposits, which is a portion of insured deposits, but reciprocal deposits at community banks because really heightened awareness and deposit sensitivity to FDIC insurance coverage. Those are your deposit sweep networks, and I think that's profound to see that level of growth in that area, and as well as the growth. Basically, almost the entirety of deposit growth is in the uninsured component. Tom, what do you think about that?
Well, you know that we're working on a solution here called the Community Bank Insurance Alliance because of this chart, and you guys are actively working on it with us. I don't think this problem goes away. I think it gets bigger because I think companies are doing fairly well right now, and so they've got bigger balances that they've got to carry. And right now I think there is a little bit of fear in the bond markets. And so everybody's saying, I'm just going to keep it short until I know what rates are really going to do. And I'm just not ready to make that call today. It's not really in the consumers. We're not really seeing an explosion of insured deposits in the consumer side. It's almost all on the commercial side of the equation. But I would suggest to everybody on the phone early second week in May, there's going to be some big announcements coming out on a thing called the Community Bank Insurance Alliance.
Nice. Definitely looking forward to that. And I think your point is very well. I mean, deposits really aren't shrinking in the United States, but the pool of institutions is. So you're going to have additional concentrations going forward.
Here's an unknown fact. 33% of all the deposits in the US are uninsured. Now, what's interesting is for institutions under 500 million, 30% of all their deposits are uninsured. So even though all the growth recently has been in the big banks, and that's absolutely true, the small community banks, even the small to the small, they still have a lot of uninsured deposits.
You know, Don, I'll tell you this story. This is what I've been sharing on the road, and it tells you how bad I suck as a dad, just for the record. Like I failed. I was a banker for 20 years and failed because my son calls me up. He's like, "Hey, Dad, there's this really cool fintech that I'm going to go move over my account to, direct deposit, blah, blah, blah." And my first question was like, "Hey, buddy, is it a FDIC insured?" And he goes, "I don't even know what those words mean." And I was like, "Oh my God, I failed as a dad, right?" But you go look, like, then I started asking my daughter's friend, all my son's friends. I think there's a whole generation that's coming up that have no clue what the hell those words mean. And I think that's what scares me, is I just don't think the next generation knows.
Yeah,
I agree.
Don, just to elaborate on your point about a lot of those deposits coming from the commercial sector, I think any ability to assuage concerns on the part of those companies to place money into community banks because of the risk that those will be uninsured, I think eliminating that could be materially beneficial, would be materially beneficial to community banks in their efforts to attract corporate deposits.
Yeah, I mean, I think if you look at the banks in Massachusetts that have secondary insurance, so it's called DIF, DIF, you'll see that their tagline says FDIC insured and DIF insured. And they're playing that for all it's worth because they're basically out promoting 100% of your deposit with us is insured. And that's what the CBIA that we're working with you guys and some other big name organizations, that's what that's going to do.
And Don, you might just go on and elaborate and say that that project has been underway for some period of time. This is not just something that developed overnight.
No, that we're now going into our 14th month, but we're there now. We're at the finish line, and I expect that it'll all come together. We're actually meeting with the FDIC chair tomorrow on it, and I expect that we'll see movement probably the middle of May. Is when I would expect that this will all roll out. But if anybody who has any questions, feel free to reach out to Rick or Matt. They know everything that's going on, or feel free to reach out to us, and we'll give you some preliminary indication of what's going on.
I'm excited. I'm ready.
Well, we'll all be looking forward to that date in May for the big announcement. Well, with that background, that excellent background that you provided on the economy, let's just take a few minutes, and we're going to go through this pretty hurriedly. But Alan, if you would, most of the information that I'm going to present today is based on smaller institutions. Let's just say those below 10 billion in assets. Alan has put together information for publicly traded banks. So I thought it might be of interest to the group for him to just go through and talk about the first quarter of this year with regard to publicly traded institutions. So go ahead, Alan.
Yeah, and I'll hit these in the interest of time real quick, Rick. But if you look on the left-hand side, and this is on a link course, this is comparing Q4 to Q1. And just at a very high level, you look at core earnings per share versus expected actual. You see the delta over on the right-hand side.
And Alan, Alan, it's fair to say that a green number there, Delta, is a good thing, right?
Yeah. Yeah.
Okay.
And the left-hand panel are your money center banks, and your right-hand panel are all the other banks under their coverage universe. And it's just a couple of observations. If you look at the loan expected growth on a linked quarter basis at 4%, I'm on the left-hand panel now, it's 8.5% on the universal banks. On the coverage universe, you look at the loan growth of 4% at 6.9. You go down and you look at the average earning assets of both. I mean, what you're seeing is an industry that is outperforming expectations by a pretty wide margin, both in terms of core earnings per share growth, loan growth, average earning assets, net interest income, each one of these. The other thing that I'll just at a very high level, if you look at the average shares outstanding, and that's the third row down under both cases, what's happening is that public banks are basically doing buybacks or reducing the number of shares outstanding, so that earnings per share number looks better. But what that speaks to is that people feel better about the capital base, right? And so you're seeing, an industry that is really kind of hitting on all cylinders. The other piece that I'll mention is, if you look at the provision going down the income statement, an expected increase of 14%. On the left, it only increased 5%, and then on the right panel, 8% compared to 2.2. So credit risk is not as high as people expected. However, we talked earlier about the possibility of the increase in gas prices, what that may do to the consumer and pushing through. But right now, things look pretty good. And if you go to the next slide, Rick, just real quickly, all that is year over year, right? So the previous slide was on a linked quarter basis. This is year over year. And again, what you're seeing is, just look at that core earnings per share expected almost 14%, 25%, a delta of 12%, right-hand panel, core earnings per share of 16, 23. And again, that's aided by the average shares outstanding in both cases are lower. But what you're seeing here is good loan growth, good balance sheet growth, people buying back capital. Credit risk is lower. Look, bankers are always worried about something, right? That's just, they're born worried. I was one for 30 years, but this is a pretty good time to be a banker, notwithstanding some of the geopolitical things that we saw earlier. If you go to the next slide, Rick, and again, I don't want to take, you've already hit that. Okay, so I will just say, in terms of high levels, again, good earnings, good credit risk, good capital levels, good loan growth. There is pressure on deposits. People on the line are certainly more capable than I am to talk about deposits. I will say, I think one of the challenges, particularly with community banks, is not only the lack of deposit growth, but how they get them. In terms of, typically people come in renewing CDs, opening money market accounts, and you think about how easy it is to do in an online space now. Not only is the challenge deposit growth, but how do we create those verticals for clients to engage with us? I think that's a challenge, but it's a good time to be a banker. And valuations seem to support that as well. If you go back and you look at PE multiple expansion, you've seen some nice improvement, which has aided M&A activity. So good time to be a banker, in my opinion.
Thanks for that, Alan. Don, do you or Sean want to comment on that, or Matthew, this may be one that you want to comment on as well?
Yeah, I've seen sentiment in banks turn around. Like, I'm going to talk about the innovation side because I'm the technology guy. You guys are by far the experts in this world. But I'm hearing more banks figure out, hey, how do we go diversify income? How do we go get these deposits? And I think probably 5 years ago when we started this whole thing, banks did never pick up the phone and call. And so now they're very focused on it. They're figuring out ways. So I agree with Alan. I think it is a good time to be a banker. Of course, we are bankers helping bankers. We're always fired up about it. So,
okay, let me start to walk through as I said earlier, we're just under 3,000 banks that have reported that this information that I'm sharing with you is built on for the first quarter. So it's not all banks, but it does include, it's heavily oriented to community banks. So with that in mind, I want to just go through, first of all, some growth rates very quickly. If we look at asset growth, it declined a little bit in the first quarter. but has remained relatively steady over time. And it's also important to point out that we're looking at growth quarter to quarter, not annualized. So the numbers that you were just looking at that Alan was talking about would aggregate those numbers over a year. Percentage change in deposits, a little bit of a boost in deposits in the first quarter. But again, those numbers have been relatively constant over the last 3 quarters. Loan growth diminished a little bit in terms of the percentage growth, but we are still seeing growth in loan portfolios. Loans to deposits, pretty steady. I mean, hasn't really moved materially over time. If we look at the loans to deposits along with the rates of growth for both loans and deposits at the bottom, superimposed in the same graph. Okay, this is one that we just talked about a minute ago, but I do want to comment on. Accumulated other comprehensive income up until the first quarter of this year. That number, a negative number, means there's growth in accumulated other comprehensive income. And for the first quarter, over the last probably 6 to 8 quarters, that number actually increased a little bit. So as Don said a moment ago, this remains something that is in the minds of and important to bankers. Return on average assets, improvement. If we look at efficiency ratios, improvement there. And the big, I think the big change here was that from last quarter where you saw a spike in overhead expense at 275, that number dropped precipitously in the first quarter. And that's typical. We've talked about that in the past, that there are a lot of expenses that get included in the last quarter of the year, and then things return more to normal in the first quarter. So even though revenue declined, there was an even bigger decline in overhead expense. And that really was the driving force there.
You know, Don, real quick on that efficiency ratio, just, you know, we get a lot of calls from BHB on AI and is it going to drive down the efficiency ratio? And really, what are we seeing? Even at the board level, I've said on several different boards as they come in and talk about this. So what does your gut tell you, man? Like, as we see AI come out, I think banks are looking for ways for efficiencies. I really think they're trying to automate manual processes, really where they're focused on today. You know, what do you think this is going to do for our efficiency ratio? Is it going to drive it down, you think?
I think it almost has to. You know, if you break into the component parts of the efficiency ratio, the real problem is twofold. Not enough fee income, but that's secondary. The biggest problem is our operating expenses are through the roof in our business. We have not been able to control and cut costs. And so to the extent that AI or any productivity measure can effectuate a lower cost structure, if the efficiency ratio is going to benefit. I was making a note while you were showing this. I think the efficiency ratio is going to have to be in the mid-50s for banks to be competitive. And I don't think that's 5 years from now. I think that's at the end of this year. So I think you're going to see major movement in cost structures during 26. Because we can't generate fee income. They're not going to let us drive fee income. It's just not there.
Yeah. No, I agree with you 100%, Don. And I think that's just as important as the comments you made on expenses. Look, for as long as I've been in banking, there's been conversation about improving fee income, but it never happens because there's just not that many opportunities. The mortgage business is really pretty dead still. And without that component, there just aren't that many other opportunities except on the deposit side. That's where most of the growth opportunities are. And that's why deposits, especially transaction deposits, are so important. Alan, you were going to comment. Go ahead.
Well, I was just going to say that Don made the point earlier about some of the industries that are reducing staff, and you haven't seen that yet filter through the banking industry. The one thing I'll say about AI right now for a lot of the community, just try something. I mean, you don't have to boil the ocean, but we see some applications in compliance, fraud management. I mean, just try something to kind of get comfortable with deploying AI. And I think over time, you're going to feel a little bit more comfortable about utilizing it. And I think that therein lies maybe the opportunity long term.
Yeah.
Yeah,
I'm going to really speed up because we need to, I'm not going to get through everything. But I do want to just point out that if you look at loan yields over the last 3 quarters, you can see that the trend is down, but still, strong. Cost of interest-bearing deposits declining even more rapidly, and the overall cost of funds declining as well. So all of those are positive factors. But if you look at margin, we did see a little bit of a decline, but I think there's opportunity for improvement in that as we move through the year. Non-interest expense, I'm sorry, I didn't update this one. That's for the last quarter of last year. Now, provision. We saw a higher provision in the fourth quarter of last year. That number declined. If there were alarms on the part of credit quality, I think you'd see a more aggressive posture there. If we look at non-accruals, those are going up. But if we look at charge-offs, net charge-offs, those numbers, aside from the fourth quarter of last year where you got banks trying to clean up a little bit and include stuff there. And then if you look at the loan loss allowance, just rock steady over time.
It doesn't get any flatter than that.
No, it doesn't get any flatter than that. So let me end. And
the problem with the loan loss allowance is on a regional basis, if you come to the New York region, which is where we've got substantial risk, our ACL is now, the median is below 1. We're at 96. And so the rest of the country, like you said, is way up there in the 115 to 120 range. But the New York region is leading the race to the bottom. And that's going to create a lot of angst in Washington. There's already discussions about what are they going to do about that.
Right. Well, we are reaching the end of our time together. Let me just close out by saying that we sincerely appreciate everyone's participation. We're particularly happy to see so many bankers in the session today, and we hope that's a trend that will continue. Our interest in bringing this information is to help you as much as we possibly can to be aware of some of the trends that are going on that are important. And Don, I will be very anxious to follow success that you mentioned with the CBIA. I think it has the potential to be a huge benefit for community banks in particular. And I'll let you close out if you have any closing remarks you'd like to make.
Well, I would just tell you, the industry right now, I think Alan nailed it, is really in a strong position. We have more capital than God, 10% tangible equity, 11% tier 1 capital, 16% risk-based capital, and those numbers are rising. We're clearly not leveraging the way we should be, which is interesting that the regulators just said we need less capital, and yet banks aren't able to achieve it. You've just shown asset quality remains strong, earnings remain strong, 1 ROA, double-digit ROE. Where we're seeing the hole is most banks have not adopted time series liquidity, so the liquidity numbers still look bad. That, to me, is an abomination. We should all be green and all have ones in liquidity, and the fact that we're not adopting time series, to me, is a major problem. We are going to have major regional differences right now. And I think the regulators are trying to figure out what to do with that. You pointed out one slide that I just wanted to address, and that is we expected much bigger betas on the deposit side of the house. Everybody's ALCOs forecasted really much bigger drop in deposit rates, and we didn't experience that. So I think everybody in their ALCO process really needs to re-examine what they're using for betas and saying, is that really a real kind of a number or not?
Right. One last thing. We would encourage you guys, all of you who are participating today, to share your thoughts. If there's other kinds of information you'd like to see, if you'd like to see us focus differently, we're flexible. We want to bring information that's going to be the most meaningful to you. So please share your thoughts. We love to hear from you. And again, thanks for your participation today. Sean, do you have anything else in closing?
I'm just thankful to have Don with us, and I'm happy to see Alan's pretty face, and of course I see your face every day, Rick. So yeah, it's still
not
pretty.
Have another joke.
Well, yeah, yeah.
Hey, Sean,
I didn't have one teed up, so
You kept going over those slides, and I think you said earlier that WTS stands for, well, that's fantastic, but I don't feel like that's what that meant on those slides.
Yeah.
We'll leave that to the participants to figure that one out.
All right.
Thanks for having me, gentlemen. I enjoyed it.
Thanks, guys. Appreciate it.